Welcome back, everyone. In this episode, we have an exciting video to get into. We're going to be looking at a full interview with Reed Hastings, and I'll be giving my reaction to it. Reed Hastings is the CEO of Netflix, which is one of my biggest positions. This has been a disastrous stock pick so far this year. I've been mocked. I've been made fun of. I was buying Netflix at nearly $500 per share, and the stock price has come down a little bit. It's now trading at $318. At one point, it was trading around $175. So this company is really volatile. The stock price is all over the place. It's dropped over 70%. Now, I'm one of these crazy investors and one of the only ones I know on social media that really likes Netflix as a business. And even though this year has been disastrous, with the stock price falling 47% year to date, I'm still bullish. I still like the company. I don't think things are as bad as the media portrays. I think things are actually going pretty well with Netflix. The growth has slowed down a little bit. This year's growth has slowed down in terms of subscriber numbers, but Netflix continues to raise prices. They continue to come out with good content. They have a lot of things going for them, in my opinion. In fact, I'm still so bullish on Netflix that I actually increased my stake nearly threefold on the company over the past year. I originally invested $10,000 into the company, and as it's continued to trade down, I've dollar cost average into it, investing a total of $30,000. Right now, it's one of my biggest losers. I'm currently in the red by $10,000 of unrealized gains. And I'm still firmly in the camp that I ultimately believe I'll make money on this company. I really do. Not only that, but I do believe that I'll actually beat the S&P 500 over the next 10 years. There's so many things going for Netflix that I still like about the company. Now, in terms of Netflix, one of the big parts of the thesis of this company is the leadership. They are long-term, value-oriented, customer satisfaction-oriented. They don't make decisions about next quarter or even next year. They make them over the next 5 to 10 years. And part of that is with Reed Hastings. This CEO, I think, is a particularly good CEO. I think he's just a very smart person. He makes good judgment calls. He turned a DVD by mail business that was fighting with Blockbuster into a streaming service, then a streaming service that rented other people's properties into a powerhouse production company. And now Netflix is the only streaming service at scale that's profitable. It's the only one that's accomplished that. And the other streaming services are having a tough time now trying to catch back up to Netflix. Let's go ahead and start off, and I've highlighted what I think are the most interesting parts of this interview that I'll be reacting to. Here's the first part where he goes in to the growing competition that suddenly happened over the past couple of years with streaming. Here's Reed Hastings' thoughts on it.
But, broadly, entertainment, we compete with TikTok, with Fortnite, with HBO, with Disney. But 4 years ago when I was here, nobody was in streaming. We did streaming and they did linear, and broadly, there was Hulu, but broadly that was the lines.
Basically what he's talking about here is competition. Reed Hastings, a couple years ago, he had an interview with Andrew here, and Reed Hastings said, our biggest competition is basically sleep. That's who we compete with. Late at night, people either choose to watch Netflix or go to sleep. And so he considered, and it was kind of one of those scoffing remarks, right? Sleep is our biggest competitor. Now that's being used against Reed Hastings. There's big streaming services. You said it was just sleep you're competing with. So he's kind of responding to this, explaining that Netflix in entertainment is competing with everything. They compete with Fortnite. They compete with anything you choose to do as an evening activity, but that's always been the case. This is one of the points that I brought up with Netflix. I don't think that HBO or Disney Plus are necessarily new competition because there's always something that Netflix has been competing with. They've been competing with YouTube, they're competing with TikTok, like he says, Fortnite and other activities.
And Bob Iger, to his credit, saw back in 2017 or so that Disney's future was going to have to be streaming. And he moved. We had been paying him a lot of money on a pay-one deal, and he moved to cut that off and to build the Disney Plus service. Super aggressive pricing, and then they exploded. And because of their enormous success, everyone else, Paramount, et cetera, piled in. It's become a brawl now in streaming of premium content. And then, of course, we've got, on the user-generated side, tremendous competition there, and on the gaming side, and then sleep. Right. A lot of competition.
But what do you think about the fact that the market cap of this company, we were at $700 billion at one point.
Andrew got that wrong. The stock price was at $700. The market cap of Netflix was a little over like $200 billion. It was never close to a $700 billion company. And Reed Hastings here, I think he responds to that.
Well, $700 stock price, but well, go ahead.
And here we are, and people have sort of reevaluated all of this, the metrics with which they measure your success.
Yeah.
The idea that subs, the race for more subs is the way to do this. And now people are actually looking at the underlying economics in a new way.
Yeah, well, I would say...
This is a really good question by Andrew, even though he got the little $700 thing wrong. The question is the focus from investors. For a long time, investors were just focusing on sub numbers. And then with 2021, as investors change focus, generally speaking, in the market, they also change focus with streaming companies. Instead of sub numbers, now it's a big focus on profitability. The great thing for Netflix, and I don't think that Reed Hastings goes into this much, but the great thing for Netflix is they already got their sub numbers up to a massive number, 223 million. They're at the highest level they've ever had before investors demanded that they start focusing on profits. Other streaming companies like Disney or Paramount or Peacock or HBO, they don't have their sub numbers up, and their investors are saying, we want to be profitable. They're trying to say we can't be profitable until we get our sub numbers up. So they have this much more difficult situation than what Reed Hastings is in right now. Netflix is actually in a very good situation right now.
Investors have always been pretty thoughtful about focusing on earnings potential. And, that's been the core focus. And that's the core focus for us, which is, engagement. How do we please consumers, revenue, and operating income? I would say media trying to serve consumers, talk about subscribers, because it's easier to understand than 32 billion of revenue,
right.
Et cetera. So the simplification, in the press is streaming wars, subscriber battles, and that tells a good story. So that makes sense. But investors have really been quite thoughtful
right.
about earnings potential, and what they were down by more than half, and that's because they're scared that the competition may have a really big impact and beat us, and we have to show no, actually, that we're going to have the most incredible set of films, Slumberland, Glass Onion, again the show Wednesday I was watching last night, which is the biggest English language show we've ever had in our history, just launched.
I think Reed Hastings is correct in identifying why Netflix stock dropped. And I think that's important for a CEO to be correct on, because if he can identify why the stock dropped, he can probably identify what the solution is. The stock dropped because of a slowdown in subscriber gains, investors focusing too much on just subscriber numbers, not the operating metrics of the company, and because of a recent intense influx of competition from other streaming competitors and concerns surrounding that. So Reed Hastings needs to guide the hands of investors and say, look, you got to focus on the operating metrics of the business, not just the subscriber numbers, and we can beat out the competition. He needs to prove that as well. So I think he's correct in both parts of this assessment.
But don't you think that this has caused a reevaluation for you? I mean, we just talk about advertising, the idea that you would ever put advertising on Netflix. And you, I think, stone-faced would say to me, absolutely not, never. We would never do that. And yet here we are, and it's happening. What's the lesson of that? When did that happen for you?
I dare you to find that quote where I said never. Look, I've got two religions, customer satisfaction and operating income, and everything else is a tactic.
That's a quote that I've never heard from Reed Hastings, that he has two religions, customer satisfaction and operating income, and everything else is a tactic. And I think that's very interesting. He has more of a focus on customer satisfaction than I think most companies. They really do try to stick to things that they think customers love, even if on paper it's not the perfect thing at the perfect moment. An example of this is binge watching. Netflix has been very reluctant to do what every other streaming service is doing by stringing out episode after episode, week after week, turning one series into a three-month thing. They just throw it all out there in a weekend. They might split a series into two parts, but they still stick with their binge watching thing when it's very arguable just by the numbers that you make more money by stringing out these series like Disney and HBO does. So I think they do have a very good focus on customer satisfaction. I actually believe that with Netflix.
Okay, so you're right to say I didn't believe in the ad-supported tactic for us, and I was wrong about that. Hulu really proved that you could do that at scale and offer consumers lower prices, and that was a better model. So we did switch on that, and credit to Hulu and Jason Kylar are figuring that out, and I wish we had flipped a few years earlier on it, but we'll catch up, and in a couple of years, we won't remember when we started it.
Again, this is something where I see him showing a long-term perspective here. Yeah, we were a little behind on the ad tier, but in a couple years, you won't even remember when we started it. He's just looking at long-term, the overall business organically growing and evolving over time, not the next quarter or this calendar year and what the numbers have to be.
The other piece of this is passwords. For a very long time, you used to say, you know what? If your cousin or your uncle or your brother or whomever was sharing passwords, stealing passwords, whatever, we're cool with it because we want as many people engaged with us as humanly possible. And if that's the cost of it, great. Now you're saying, nope, you got to pay me.
No one's listening, so just tell me your password. Honestly, that was a thing that we grew with, not really understanding how to think about internet streaming because it's partially a TV-based service that you want. Your instinct is if your friends are over, borrowing your house or something, they should be able to watch TV and you should be able to watch when you travel. And so it's a weird thing between pay TV and a personal service. And we probably haven't done the best job of that. And you're right that next year we're going to be asking, people who are borrowing someone else's account to have their own account. But we're, setting it up so it's between $7 and $20, so they get to choose where they want to be. But you're right, we are drawing an end to that era.
But I want to just understand that
this is a little bit of PR by Reed Hastings. This is a very good answer, but I think there's more truth to it behind that. Netflix used the password sharing for over a decade as a churn reduction tool. Meaning that if I own a Netflix account and I let my sister and brother and parents and whoever share off of it, that reduces the likelihood of churn from my account because there's no way I'm going to cancel if I think that my sister might be using it or my parents might be using it. Because if I cancel, even though I'm not using Netflix, even if I don't watch anything for a month and I might consider canceling, well, they may have watched something, right? So it's a churn reduction tool. If 2 or 3 people are using the same Netflix account, it's far less likely for that Netflix account to get canceled. Now, Netflix has grown so big in the US that they've reached their saturation level. Everybody that wants a Netflix account has one. And now there's still 70, maybe 100 million people sharing Netflix accounts. And I don't think that's an exaggeration. I literally think in the US, there's probably 100 million plus people sharing a Netflix account outside of the primary residence. So you have the person living in one home, sharing it with someone that lives in an apartment or a different home, maybe in a different state. And Netflix is saying, now it's time we pivot a little bit and we start to monetize those users. Users are not going to like it. They never like paying for something that was previously free. So this is going to have a little bit of a pushback, but I think overall it will make more money. They're just going to make more money doing it. It's the simple truth.
these are a lot of big shifts for you. And what happened, meaning you weren't doing this because I would argue you wanted to. You were doing this because you felt you had to, because growth had slowed, because the market had said, this isn't working the way we thought it was going to work. The valuation was too high. Just bring us inside that.
Well, let's see, on the account sharing, we kicked off the big effort in 2019. So, we were growing at record levels then. So, but we recognized, look, account sharing, when you share with your spouse that you live with, it's fine. But when you share with your cousin who's across the country, that's a little different. And so there's some nuance there.
Now, later on in this interview, Reed Hastings talks about Disney, which is considered one of their primary competitors because Disney has been pushing so aggressively with their Disney Plus service. But he's asked specifically about Bob Iger. Reed Hastings really respects Bob Iger. He wanted to back him as a potential presidential candidate. He thought he'd be better than the candidates we have right now. So he was somewhat disappointed when Bob Iger decided not to go into politics and to go back at Disney.
I mean, I was encouraging. I was ready to be a fundraiser for him. I mean, I think he'd be an amazing. It'd be, obviously hard to win the Democratic primary, but he'd be an amazing leader for the country. So I think very highly of him. And the was darn, But again, Chapek, from our point of view, was very good, very disciplined, 25-year Disney guy. It's not like we saw any cracks. Whatever the
So you
board
didn't see
saw.
cracks.
No,
And what do you think of the hand that Bob Iger now has?
That's an interesting take. Most investors in Disney, most customers, most people that love Disney do not like Bob Chapek. They didn't consider him creative enough. But if you look at this from Netflix's perspective, Bob Chapek was a fierce competitor because he was throwing everything at Disney Plus. All of their big box office movies, all their animated movies. He was losing so much money by subsidizing Disney Plus as much as possible. So Bob Chapek was putting a strong focus on the streaming service, which is obviously what Netflix is competing with. So I don't think Netflix or Reed Hastings was really concerned when Bob Iger came back. In fact, in my opinion, I think it's a better thing for Netflix because the first thing Bob Iger did was said that we have to chase profits and not chase subscribers. They might pare back their spend on the Disney Plus service.
Disney is very likely to be a big success in streaming. They've got incredible IP. They've got, hundreds of millions of subscribers. They're off, and it'll be at least the two of us duking it out for a long time.
He doesn't say that for every company. He says Disney's very likely to be a streaming success long term. And I agree. I'm invested in two streaming companies. I'm invested in Netflix and Disney. And then, of course, if you count big tech, Apple and Amazon. But the actual two streaming companies, Netflix and Disney, are the only ones that I'm fairly certain, I'm fairly confident will be massive global successes. All these other companies are losing money. Warner Brothers Discovery is losing money with their streaming service. They lost $600 million last quarter. Paramount Plus, their actual direct-to-consumer part of their company, loses around $1 billion per year. Peacock, Comcast's venture into streaming, is at like 15 million subscribers. I mean, it's barely this little speck in the size of Netflix. None of these other streaming services are either profitable or at scale. Reed Hastings tries to be nice here and he's tactful in how he approaches this, but listen to what he has to say and how it's different than what he says about Disney.
What happens to those guys?
That's awesome. I mean, it's $110 billion of entertainment revenue that we're going to try to earn away from them. We're going to try to do the most incredible shows and the most incredible films and hopefully some fantastic games too, and then earn consumer revenue.
But what happens to the three of them? And you're in this.
That's an interesting way of putting it. We're going to try to earn that revenue away from them. That's stealing market share. He's saying we're basically wanting to put you guys out of business. We're going to steal your market share. But earning revenue away from them is the way that he phrases it. Very diplomatic.
In this sort of constellation of companies.
It's hard to tell. I mean, if you look at the consolidation, there's been Fox and Disney, CBS and Viacom, Discovery and Warner Brothers. So there's likely more of that.
So you think, would you ever see all three of them come together?
That's a long shot, but
Do you think regulators would allow two of them to come together?
Well, they certainly have so far. So, again, I think what you're going to see there is them trying to figure out streaming, and some may become like Sony and becomes arms merchants to all of us, and then they focus on producing incredible shows like Ben Affleck is doing. Right?
But let me ask you about this. This is John Malone.
I think with the competition, I think he's right that there's going to be consolidation, but it seems like no matter how you mix and match these services, it's very difficult to catch up with what Netflix has. They didn't grow by simply buying up a bunch of other huge studios and just trying to combine them together into one big service like Disney did with Fox. And I don't think the Fox acquisition has been that fantastic for Disney so far. It took on a ton of debt for that Fox acquisition. So Netflix has lower amounts of debt and they have positive free cash flow as a globally scaled streaming service. I really think the advantages they have over all these other smaller ones is so significant. And no matter how you pair and match these different streaming services, Peacock and CBS and Paramount Plus and all these other ones, you can try to mix and match them, but I don't think it's going to suddenly become better than what Netflix already has.
John, of course, is the investor behind Discovery and now Warner Brothers. He had a lot of good things to say about you. First, he said, let's face it, everybody went through this mad Oklahoma land rush, which was in reference to the Netflix land rush. And he said, Reed Hastings shareholders should build a huge monument. He got out in the lead, saw the opportunity, exploited the opportunity, and went for scale. Netflix was there early, does an excellent job. But, he says, here's the but, comma, broadening out the service, quote, by spending so much on so much content is not likely to be successful. His argument is that everybody is just spending too much, including you. What do you think of that?
I think he's wrong, but he's a brilliant guy. But again, we are committed to spend a lot to produce, the most exciting series, films, and games the world's ever seen. So that's like our singular focus. Can we do that again with incredible variety from countries all over the world? And if we can do that, we're going to do incredibly well.
Netflix's content spend run rate right now is around $17 billion, and that's what they're expected to spend over the next couple of years. So they want to flatten the budget somewhere around $17, $18 billion, and then any incremental growth in revenue is just operating leverage. That's where the free cash flow comes in. So we have Netflix spending $17 billion. If customers or if subscribers or if price increases grow at all above that $17 billion content spend, that's operating leverage. Now, moving on, we have Reed Hastings talking about the windowing strategy for Netflix. Netflix has this new movie called Glass Onion. It's the sequel to Knives Out. Knives Out is a movie that I think is one of the best ones I've seen over the past 5 years. Knives Out is fantastic. Now, Glass Onion is being released to everyone on Netflix December 23rd, but it just recently went in theaters for 5 days. They only put it in theaters for 5 days, and the analysts and the people that study this said they left $200+ million on the table by not throwing it in the box office for an additional 3 weeks. They put it in for 3 more weeks, $200 million. And Reed Hastings has to explain why it was a good decision for the Netflix shareholder to say no to all of that box office money and just have it in there for a week.
You guys, by the way, have the Knives Out sequel, Glass Onion, out in theaters, and apparently made a bunch of money.
We did.
But there's a question, which is to say, should have you gone wider with that? Was there money left on the table?
Lots.
Lots of money left on the table.
Again, the estimates conservatively were $200 million was left on the table, which a lot of investors are like, why not leave it in theaters? Why are you taking it out of the theaters already?
How much money do you think?
Why did we do that? But because we were interested in customer satisfaction on our service. So with film, we released it typically in film festivals early to stimulate conversation and demand, right? But not to fulfill that demand, except when it launches on Netflix and everybody watches. So our week in the theaters with a small number of theaters has done exactly that. Everyone's talking about it. It's exciting about Glass Onion. It's going to be huge. And December 23rd, the whole world's going to get to see it. And I think it'll be one of our biggest films. And so it's a promotional tactic like film festivals. And if it works well, we'll do more of it.
But is there ever going to be a day where, so this went to 638 theaters across the country.
This is such a different perspective than what a Bob Chapek type of person would do. Bob Chapek would want to milk the movie for as much as possible in every venue as possible. Have it the exact number of days where you get the most maximized revenue from the theater and then throw it on streaming afterwards. You can see the long-term perspective again from Reed Hastings. He wants customer satisfaction, and he looks at this as just a way to build hype.
Could you see a day where you would do a week at 3,000 or 2 weeks?
2 religions, member satisfaction, operating income, so that's what we're focused on. So we use this as a promotional technique, so then more people watch it on Netflix, because that's member satisfaction, right? We're not trying to build a theatrical business. We're trying to get people so excited and break through the noise that everybody's like, oh my God, I didn't see Glass Onion that week it was on, and everyone's talking about it. When is it going to come? And it's then everyone's going to watch it, December 23rd.
I like the strategy. I think it's a good way to promote a movie. Giving just a taste of it to a few viewers in the box office and then throwing it on streaming afterwards, I think is a great way of promoting it. I think it's going to work. I think this Glass Onion movie, December 23rd, I think it will be massive. We'll look at the numbers, but I'm guessing it's going to be one of the top 3 most watched movies ever on Netflix in the first weekend. We'll see the news releases afterwards. Maybe I'll get it wrong, but my prediction is it's gonna be massive. Now, something else that Netflix has been doing over the past year has been very confusing to me. I haven't figured this out. I don't understand the full strategy here as an investor in this company. It's the focus on video games and not sports. Every other company sees a lot of money in sports. You got Amazon, you have Apple, you have Disney with ESPN, you have all these big players trying to get as much sports rights as possible. Netflix is saying, we don't really care about sports. We'll put that to the side. We'll make documentaries and movies about it, but we don't really care about live sports. We're focused on video games. And that's just odd. Most of these other big companies, they're way more focused on sports with their media than video games. And I haven't figured this one out. Here's what Reed Hastings says about it.
Where are you on sports? We were talking to Jay DeJassy. He's doing sports. Apple's now doing sports. No sports for you yet, or at least classically.
Yeah, I mean, we're really getting focused on, talk to us after we're like a big leader in games. We got a lot of investment to do in games.
And what does that mean when you say there's the mobile gaming piece of this? Mm-hmm. You're now partnered with Microsoft. Microsoft now is selling Xbox streaming, where you can actually play straight off of a television, ostensibly.
Yeah, from the outside, it's odd because, again, we build on Amazon Web Services, right? That's what all those services based on, and we compete with them. And that's been true from the beginning, that we compete with them and we rely on them. And then at Microsoft, we rely on them on the ad sales. We compete with them in gaming. I mean, that's normal. We're, a rounding error competitor to them in games at this point. But we are focused, partially in mobile games, and we've done some acquisitions there, which is also a new thing for us.
Right.
Last 3 years, and we want to have incredibly compelling mobile games that are really most mobile games have a lot of upsell. The monetization strategy is to get you to spend money to get clothing or weapons or these things, and that distracts from the engagement. And our theory is we can build games just around engagement.
You can tell he studied this a lot. Like he knows the economy behind mobile games and all the upsells and microtransactions. That's the new way to have any type of game, not even mobile games. Desktop games are doing the same thing. You have the free game and then you have all the microtransactions on top of it, skins for different guns or items or different things. So he knows about this. He's been studying this and saying that he's not going to have that be the monetization strategy. They're just focused on engagement. Now, one thing that I wish Andrew asked him about is PC games, because he mentions mobile games, even games on the TV, but he doesn't mention PC games. And there was a report that Netflix is going into a AAA PC game, potentially, but it's not confirmed yet. Now, this next section, Reed Hastings is asked about Elon Musk and all the drama going on with Twitter, the battle with Apple, and what he thinks of Elon Musk is doing overall. And I think it's a bit refreshing and somewhat surprising that even though Reed Hastings is a liberal, he's a Democrat, he just said that he was going to support Iger and back him as president. He also speaks glowingly of Elon Musk. And Elon Musk has pivoted kind of to the hard right. So they have huge political differences, but he still speaks glowingly about Elon Musk and his accomplishments.
Since you are a Twitter user, I should ask, and you're on there all the time, what do you think?
Yeah.
What's going on?
I'm excited. Elon Musk is the bravest, most creative person on the planet. I mean, what he's done in multiple areas is phenomenal. His style is different than I'm trying to be like a really steady, respectable leader. He doesn't care. He's just out there,
He says he's trying to be steady and respectable. Elon Musk doesn't care. He's just himself. He makes jokes on Twitter. I think people like this, Reed Hastings, he has a whole career of being this steady, respectable person, as he puts it. And then you see someone like Elon Musk on Twitter, and he might just think, do I need to act this way all the time? Should I act a little bit more, myself and not try to be this, suit and tie person all the time? I wonder how it's affecting other CEOs. But I bet he sits back and just enjoys the show that Elon Musk puts on.
But think of a guy who's spending $44 billion. He could have built a mile-long yacht for $44 billion, okay? But it's not good for the planet, so he's not interested. He's in for
Do you think what he's doing is good for the planet?
Absolutely. I'm 100% convinced that he is trying to help the world in all of his endeavors, okay? And he's trying to help the world on that one because he believes in free speech and its power for democracy and that there's an option. Now, how he goes about it, again, is not how I would do it, but I'm deeply respectful, and I'm amazed that people are so nitpicky on him. Yeah, sure, the blue check mark, he's making a mess of some things or not, but it's give the guy a break. He just spent all this money to try to make it much better for democracy and society, to have a more open platform, and I am sympathetic to that agenda.
Surprising. That's not the reaction that I think I would have guessed, but it shows, I think, some maturity with Reed Hastings. Again, he is very much liberal from everything I can tell. He's Democrat, he's liberal, but he looks at the good qualities of Elon Musk, the motive behind what he's doing with Twitter, the changes that he's trying to make that really haven't happened in Silicon Valley, and I think he has a great deal of respect for that. So I enjoyed seeing his reaction to that and his thoughts on Musk. Now, this next part I think is very interesting because he's asked about Dave Chappelle and the comedy special that caused a lot of drama and backlash from Netflix. They aired this Dave Chappelle comedy special where Dave Chappelle he's ruthless. He just mocks different groups. Doesn't matter how politically incorrect it is. He'll mock anyone and anything. And a lot of people don't like that. A lot of people don't like their group being made fun of. And so there is some backlash, both outside of Netflix and within the employees themselves. A lot of people upset that Netflix aired this special. And this is where there's a different strategy between what Netflix is doing and what Disney's doing. Disney's also had some internal backlash with their executive and the creative decisions they're doing, and even things outside of their company with politics. In the case of Disney, Disney's chosen to side with the employees in their company. In the case of Netflix, Netflix says we're not siding with our employees, we're siding with the consumer. The consumer loves Dave Chappelle, so we're going to air more of this type of stuff. We don't really care if our employees are throwing a fit. They have to know that we're here to entertain everyone, not just people that agree or disagree with them. So it's a very big distinction that he makes here.
Well, that's what I was going to ask you about, because Dave Chappelle created some controversy, as you know, on your platform. And we've been talking also about platforming sometimes hate speech or anti-Semitic speech or other kinds of speech. How do you think about that today?
Yeah. Our brand is trying to be the most exciting entertainment company in the world. And Chappelle is dead center for us. He is the best, or one of the best, and that special was one of the most entertaining and watched specials we've ever had. We would do it again and again. So we clearly need to be more obvious and direct about that, which we've done since, with employees and with people who care about Netflix, that we're about entertainment. And Chappelle is very entertaining and provocative. And again, that's the core of what we're doing.
See, that's such a different approach than what most big media platforms are doing right now. Netflix is saying that we're not here to satisfy and entertain our employees. In fact, we don't even consider them family. We consider them team members in a team that's there to build a streaming platform and an entertainment platform for the customer. And the customer likes Dave Chappelle. So we're going to keep allowing different varieties of content. It won't appeal to everybody, but as long as a lot of people are being entertained by it, they're going to continue to allow it. Now, there was one disappointing part of this interview, and that is that Andrew Ross Sorkin had a question from Bill Ackman, but didn't have enough time for Bill Ackman to ask Reed Hastings. We have it right here. He says it.
I think we have to end it here, unfortunately. I'm going to let Bill Ackman off the hook because I see him up there. He was a big owner of your shares at one point.
I would have loved to hear that question that Bill Ackman had for Reed Hastings, because Bill Ackman bought into Netflix to buy the dip and then quickly sold 3 months later after they missed another subscriber number. And by the way, just on a side note, since Bill Ackman sold out of Netflix, the stock price is up over 70%. I'm still long. I'm still holding it. I've been dollar cost averaging into it, building a bigger and bigger position. I very much like this interview. I like Reed Hastings. I like the direction this company's going. So I'll keep you up to date with what happens over time. That's all for now.